Section 1. The Great Rotation. Wall Street's decisive pivot to artificial intelligence. As the final quarter of 2025 unfolded, a profound and undeniable shift was cementing its place across global financial markets. This was not a subtle tremor but a seismic event, a great rotation of capital on a scale that commanded attention. New York, London, Tokyo, institutional investors managing trillions in pension funds, endowments, sovereign wealth, were systematically reallocating vast sums of money. Their destination was clear and singular: artificial intelligence. The narrative was no longer about a speculative future, but a tangible present where AI had graduated from a niche concept to the primary engine of economic growth and investment returns. This was the moment the market fully embraced AI as a fundamental pillar of the global economy. The architects of this capital migration were the largest U.S. investment houses. They saw AI as a foundational technology layer, akin to the internet in the late 1990s, or the mobile revolution a decade later. This conviction spurred them to aggressively increase exposure, buying up shares in companies that form the backbone of the AI ecosystem. At the very forefront were the undisputed leaders: Nvidia, Microsoft, AMD. These companies had become the new blue-chip assets. The context of the fourth quarter of 2025 is crucial. It was a period marked by blockbuster earnings and strategic announcements. The numbers were not just strong, they were transformative, showcasing growth rates previously unimaginable for companies of this scale. This deluge of positive data confirmed the AI boom was a durable, long-term secular shift. Investors were not just chasing momentum, they were responding to concrete evidence that a new industrial revolution was underway, and they were determined to position their capital on the right side of history. This movement was less a speculative frenzy and more a calculated strategic repositioning. The world was rapidly integrating AI into every facet of business and daily life: drug discovery, financial modeling, consumer applications, enterprise software. That integration created voracious demand for underlying infrastructure, specialized chips, vast data centers, sophisticated cloud platforms. Companies at the center of this supply chain were capturing immense value. It was visible on income statements and in soaring stock valuations during the closing months of 2025. Section 2. Decoding the investor shift. Why AI? Why now? The fundamental question on every investor's mind. Why did this massive shift into AI stocks happen with such force in late 2025? The answer can be distilled into three core drivers. First, profits. The abstract promise of AI had finally translated into staggering financial results. Companies at the heart of the AI supply chain, those designing essential processing units, and those manufacturing them. They were reporting revenue and earnings growth that dwarfed nearly every other sector. These were not marginal gains. They were exponential leaps. Even the most skeptical analysts revised their models upwards. Second, the surge in infrastructure demand. The engine of modern AI is the cloud computing data center. These digital factories require a massive, constant supply of specialized chips to train and run complex AI models. Corporations race to develop and deploy their own AI capabilities. They turn to cloud providers: Microsoft Azure, Amazon Web Services, Google Cloud. That created a cascade of orders for the hardware that powers these services. The demand for AI chips was no longer a forecast. It was a backlog of purchase orders from the world's largest, most creditworthy tech companies. A clear, visible revenue pipeline for the foreseeable future. Third, rapid proliferation of monetizable AI products and services. The tech moved beyond the research lab. It was embedded directly into software and platforms used by millions. Microsoft integrated Copilot into Office 365. Adobe embedded Firefly into its creative tools. Countless startups launched LLM-powered applications. Customers were willing to pay a premium for AI-enhanced features, creating new, high-margin recurring revenue streams for software companies. AI proved to be a profit center, not just a research cost. Those three catalysts created a powerful feedback loop. Stellar earnings, soaring infrastructure demand, successful product monetization. Companies reported blowout quarters. Wall Street analysts raised future earnings estimates. Analyst upgrades often act as a green light for portfolio managers. Capital flowed from mutual funds, from hedge funds, and from exchange-traded funds, ETFs. That buying pressure propelled stock prices higher, attracting more investors, reinforcing the narrative that AI was the place to find supercharged growth in an uncertain economy. Section 3. Nvidia, the undisputed monarch of the AI chip boom. Q4 2025. No company stood taller. It had become the indispensable arms dealer in the global AI war. Its financial performance matched that dominance. The primary beneficiary of a huge appetite for high-performance GPUs. GPUs, the gold standard for running large-scale AI models. Its earnings report was spectacular. Revenue growth exceeded the most optimistic Wall Street forecasts. The velocity of sales made its grip near monopolistic. The sources of that demand were the world's biggest tech companies, cloud service providers, enterprise data centers, national AI initiatives. These chips are the building blocks for AI services. Beyond the cloud, sovereign nations, large corporations building private AI data centers. Nvidia was no longer just selling chips. It was selling the picks and shovels for a new technological gold rush. And it had the best tools on the market. Its strategic position was fortified by high-profile partnerships and supply agreements. Nvidia locked in long-term deals to supply next-gen AI accelerators for newly planned data centers around the globe. That ensured a robust revenue pipeline for years to come. Nvidia was shaping the future of AI, not just reacting to demand. Its stock price reacted with explosive force, climbing sharply throughout the quarter, cementing its status as one of the most valuable companies in the world. For many investment funds, holding Nvidia was no longer optional, it was necessary. The ripple effect was felt across the entire market. Its performance became the benchmark for all AI investments. Portfolio managers overweight Nvidia dramatically outperformed. Those underweight were forced to chase the stock, adding momentum. The story was simple and powerful for investors. Nvidia made the one thing everyone in the AI economy desperately needed. That clarity and dominance made Nvidia the quintessential winner of Q4 2025. A monarch reigning over its Silicon Kingdom. Section 4. Microsoft, the Cloud King's strategic AI empire. While Nvidia dominated the hardware narrative, Microsoft masterfully played its hand in the software arena. Microsoft masterfully played its hand in the cloud services arena. The Redmond-based giant demonstrated a powerful and multifaceted strategy that leveraged its immense scale and deep enterprise relationships to capitalize on the AI revolution. The company's fourth quarter of 2025 performance was a testament to the success of this approach, showing robust growth driven by the intelligent integration of AI across its entire product ecosystem. Microsoft wasn't just selling access to AI, it was weaving it into the very fabric of the tools that businesses rely on every day, creating a powerful and sticky value proposition that investors found deeply compelling. The primary engine of Microsoft's AI success was its Azure cloud platform. The company had invested billions in partnership with OpenAI, securing early access to cutting-edge models and integrating them seamlessly into its cloud offerings. This allowed Azure to become a premier destination for developers and corporations looking to build their own AI applications and deploy their own AI applications without the immense cost of building their own infrastructure. As a result, Microsoft's cloud revenue continued its impressive upward climb, with a significant and growing portion of that growth directly attributable to consumption of AI services. This proved that the company could effectively monetize the hardware it was purchasing from partners like Nvidia. Beyond the cloud, Microsoft executed a brilliant strategy of embedding AI directly into its flagship software products. The Copilot AI assistant, integrated within the Microsoft 365 suite of applications, became a major selling point. Word, Excel, Teams. The company successfully convinced a growing number of its enterprise customers to pay a premium subscription fee for these AI-enhanced features. This created a significant new stream of high-margin, recurring software revenue. For investors, this was the holy grail, a clear path to monetizing AI through an existing customer base of hundreds of millions of users, dramatically reducing customer acquisition costs and accelerating adoption. This dual-pronged strategy, growing its AI cloud infrastructure while simultaneously upselling AI features in its software, made Microsoft an incredibly attractive investment. Its stock price posted solid gains during the quarter as investors recognized the stability and long-term potential of its business model. Unlike the more cyclical nature of hardware sales, Microsoft's software revenues and cloud revenues offered a promise of steady, predictable growth. The company wasn't just participating in the AI boom, it was building a durable, integrated AI empire, benefiting from both the infrastructure build-out and the application layer, securing its position as a core holding for any serious AI investor. In any market dominated by a single powerful player, the role of the challenger becomes critically important. In the AI chip space of late 2025, that role was adeptly played by advanced micro devices. While Nvidia commanded the spotlight, AMD was diligently executing a strategy to carve out its own significant share of the lucrative AI accelerator market. The company made notable strides in the fourth quarter. Demand for AI processing was large enough to support more than one major supplier. AMD's progress was a key subplot in the AI investment narrative, offering a compelling alternative for customers, offering a compelling alternative for investors. AMD's primary focus was on improving and marketing its own lineup of server chips. AMD's primary focus was on improving and marketing AI accelerators. The company's MI series GPUs were designed to compete directly with Nvidia's offerings. They had not yet unseated the market leader, but were gaining traction. A key part of AMD's value proposition was performance per dollar. It positioned its products as a cost-effective, yet powerful alternative. An appealing message for companies managing the immense expense of building out AI infrastructure. As more data centers began to test and qualify AMD's products for AI workloads. As more cloud providers began to test and qualify AMD's products for AI workloads. The company's sales figures began to reflect this growing interest. The market's reaction to AMD's progress was decidedly positive. Investors, wary of Nvidia's near monopoly and sky-high valuation, saw AMD as a smart diversification play. The belief, the AI market was too vast for a single company. Any evidence AMD captured even a small slice was a major win. This interest showed in the company's stock performance. The stock saw healthy gains. Reports of new customer engagements bolstered confidence. Rising server chip sales bolstered confidence. AMD was positioning itself as the credible number 2 in a two-horse race. This dynamic was crucial for AI hardware market health. Presence of AMD helped mitigate concerns about pricing power. Presence of AMD helped mitigate supply chain concentration. For customers, it meant negotiating leverage. For customers, it meant a hedge against potential shortages. For investors, another way to gain exposure to the AI hardware boom. For investors, a different risk and reward profile. AMD's Q4 2025 story, determined execution and growing market acceptance, proving there's room for a well-run challenger to thrive and create significant value. Section 6. The calculus of returns, gauging future AI profits. For investors, past performance is interesting, but future returns are what truly matter. In the context of the AI stock boom of late 2025, Wall Street analysts tried to quantify future expectations. Using a variety of financial models and industry forecasts, they attempted to project the potential upside for the sector's leading companies. In simple terms, the consensus view was overwhelmingly optimistic. Many prominent analysts published research reports forecasting sustained high returns for AI leaders like Nvidia, Microsoft, and others over the next 3 to 5 years, creating a powerful tailwind for their stock prices. Under the most bullish scenarios, some forecasts pointed to potential annualized returns of 20% or more. These optimistic models were predicated on a set of aggressive but plausible assumptions. That the demand for AI chips would continue to grow at an exponential rate, that cloud services demand would grow at an exponential rate, that companies would maintain their high profit margins, and that new AI applications would unlock even larger markets. These projections were not just idle speculation. They were backed by detailed analyses of corporate spending plans, data center construction schedules, and the accelerating pace of AI adoption across industries. This created a compelling narrative of a multi-year supercycle of growth. However, the world of finance is never without its skeptics, and more cautious forecasts also circulated. These models projected more modest returns, factoring in the possibility of slowing growth as the initial infrastructure build-out matures. They also considered the potential for increased competition to erode the high profit margins currently enjoyed by the market leaders. The existence of these more conservative estimates highlights a key aspect of the AI investment landscape. While the long-term trend is widely believed to be positive, the exact pace and magnitude of the growth path remain subjects of intense debate. This wide range of expected returns signified a market that was hopeful, but far from certain. Ultimately, the collective expectation of strong future returns became a self-reinforcing driver of the market. When a critical mass of influential analysts projects strong growth for a company, it signals to large institutional funds that the stock is a buy. This influx of capital pushes the price up, validating the initial bullish thesis and attracting more investors. The exercise of forecasting returns, therefore, was not just an academic one. It was an active force shaping market dynamics in real time. The promise of significant future profits, even with a wide band of uncertainty, was the magnetic force pulling immense amounts of capital into the AI sector throughout the fourth quarter of 2025. Section 7. The four pillars, macro forces propelling the AI sector. The spectacular rise of AI stocks was not built on hype alone. It was supported by four powerful, interconnected forces. These four pillars form the foundation for the sector's growth. Pillar 1. Continued expansion of cloud computing. For over a decade, companies have been migrating from on-premise servers to vast, scalable cloud data centers. That trend created the infrastructure for the AI revolution and provides a steady tailwind. Pillar 2. Explosion of new AI applications. Powerful generative AI models unlocked a wave of innovation, leading to new tools for software development, content creation, scientific research, customer service. These applications delivered real productivity gains and business value. That utility drove rapid adoption and rising computational demand, fueling hardware and cloud services across the value chain. Pillar 3. Massive global increase in data center spending. Tech companies launched an unprecedented Capex cycle. They invested tens of billions to build new data centers and to equip existing ones with the latest AI accelerators. Section 8. Navigating the minefield, the inherent risks of the AI gold rush. Despite overwhelming optimism, prudent investors remained acutely aware of significant risks. No market goes up in a straight line forever. The AI boom of 2025 was no exception. The first and most frequently cited risk was valuation. By the end of the fourth quarter, stock prices of many leading AI companies had risen to dizzying heights. These valuations were based on future growth expectations, not current earnings. If that growth fell short, prices could correct sharply and swiftly. The higher the valuation, the smaller the margin for error. The second major risk was rising competition. Nvidia's extraordinary profit margins acted as a powerful magnet. Other semiconductor firms raced in. Major cloud providers started building in-house chips. A wave of well-funded startups surged forward. Technological leads can be fleeting. More competitors could trigger price wars and compress margins. A third cloud on the horizon was government regulation, growing debates over data privacy, concerns about algorithmic bias, questions of national security, fears of job displacement. New restrictive rules could slow innovation or raise compliance costs. Traditional business risks remain too. Manufacturing advanced semiconductors is a complex global process. Geopolitical tensions could disrupt supply. Natural disasters could halt production. Logistical bottlenecks could choke shipments. Any major interruption could constrain sales growth, regardless of demand. Section 9. The road ahead. A balanced outlook for 2026. Looking forward from the exhilarating close of 2025, the outlook for the artificial intelligence sector over the next 6 to 12 months is one of cautious optimism, framed by a wide spectrum of potential outcomes. The prevailing sentiment on Wall Street is that the fundamental drivers of the AI boom remain firmly in place. However, the market will be intensely focused on whether the pace of growth can be sustained after such a period of explosive expansion. The narrative will shift from the initial promise of AI to the consistent, quarter-over-quarter execution required to justify the sector's premium valuations. The coming year will be a crucial test of the industry's durability. Three primary scenarios define the range of possibilities for 2026. The bull case envisions a continuation of the powerful trends seen in 2025. Corporate and cloud spending on AI infrastructure remains exceptionally strong. Chip makers successfully navigate any supply constraints, and the adoption of monetizable AI software accelerates. If this comes to pass, earnings would likely continue to exceed expectations, potentially driving stock prices even higher. This outcome relies on the global economy remaining stable and the demand for AI capabilities proving to be even deeper and more sustained than currently projected. A more moderate base case scenario suggests that while growth will continue, its pace will inevitably slow down. After a massive initial build-out, the rate of new infrastructure spending may normalize. In this environment, AI stocks could still deliver positive, albeit more modest, gains. Earnings would continue to rise, but perhaps more in line with, rather than dramatically exceeding, analyst estimates. This soft landing for the growth rate is seen by many as the most probable outcome, representing a healthy maturation of the market from a frantic boom to a more sustainable long-term growth phase. Finally, the bear case cannot be dismissed. A global economic downturn that forces corporations to cut back on IT spending, a significant competitive disruption that erodes profit margins, or the imposition of unexpectedly harsh government regulations. In such a situation, growth could falter, and with valuations already stretched, stock prices could experience a significant correction.